Unilever just posted a massive beat for the first half of 2026. Underlying sales growth hit 4.8%, driving total turnover to 25.6 billion euros.
Yeah, and underlying earnings per share came in at 1.61 euros, which is up 2.4%.
Right. And looking ahead, management actually upgraded their full year 2026 outlook to 4 to 6% underlying sales growth.
With about 3% of that expected to come from actual volume, which is huge.
It really is. They are also anticipating a modest improvement in the underlying operating margin versus 2025's 20.0%. So today is your roadmap to unpacking how Unilever is actively pivoting into a pure-play health, personal care, and home company.
We are going to dig into the shifting segment margins and some pretty glaring geographic divides.
Exactly. And we'll evaluate the actual mechanics of the Perform and Transform strategy that is driving this quarter's massive cash generation. So let's look at the mechanics of this beat, because that 4.8% underlying sales growth, or USG, is the real story here.
It is. I mean, USG strips out all the currency fluctuations and corporate acquisitions, right? It shows you how the core business is actually doing. And for the past couple of years, this entire sector was just dominated by inflation.
Yeah, companies were padding their top line purely through relentless price hikes, even as shoppers were, buying fewer physical items.
But for Unilever in this first half, out of that 4.8% growth, 4.2% came directly from underlying volume.
Wow.
Yeah, only 0.6% came from pricing.
And that momentum actually accelerated as the half went on. If you look at just the second quarter, the USG jumped to 5.8%.
Right, with volume growth hitting 5.5%.
To put this into perspective for you, getting 4.2% volume growth over a 6-month period across a massive global portfolio, it's like a major retailer finally engineering a way to get significantly more foot traffic through the front doors.
Instead of just trapping the existing customers inside and shaking them down for a few extra pennies.
Exactly. It represents real physical demand.
Volume growth is, it's really the most fundamental indicator of brand health. It literally means consumers are actively choosing to put more of your physical products into their baskets at the checkout line.
Right, but you also have to analyze what it costs the company to get those people in the door.
Sure. Their underlying operating margin ticked up 10 basis points to 20.3%.
Supported by a gross margin of 46.8%, which is solid.
It is. But here is the crucial data point you have to monitor. They achieved that margin expansion while maintaining a very heavy brand and marketing investment, or BMI, at 16.1% of their total turnover.
Which is high.
It is high. Plus, this whole operational machine delivered 1.5 billion euros in free cash flow for the half.
So that is up €500 million compared to the first half of last year.
Exactly. Free cash flow being the actual cash left in the register after paying to keep the lights on.
I am looking at these gross margins, though, and I really have to push back a bit here.
Okay, what are you seeing?
Well, the report explicitly notes a decline in gross margin linked to commodity cost inflation. Things like agricultural inputs and raw chemical materials are getting significantly more expensive.
Right, the raw material headwinds.
Yeah. Yet they are still spending 16.1% of their revenue on marketing, which management admitted is well above the peer average. So are they essentially just buying this volume growth?
What do you mean by buying it?
I mean, if you flood the zone with marketing and TikTok ads, and keep price increases relatively flat at just 0.6%, and you just eat the rising cost of raw materials, sure, volume goes up, but is that actually sustainable?
Right.
Or is it just masking the margin pressure from those commodity costs?
That is the ultimate test of the perform aspect of management's current strategy, because they aren't just blindly throwing money at advertising to temporarily buy market share.
Okay, so what is keeping it sustainable?
Severe internal cost discipline. When commodity costs rise and squeeze your gross margin, you basically have two choices. You raise prices on the consumer, or you cut your own internal operational costs.
And Unilever's choosing the latter.
Exactly. They are funding that 16.1% marketing spend through rigorous internal savings elsewhere in the business. And the proof that this strategy is actually yielding structural returns lies in where that growth is localized. You have to look at their power brands.
Okay, so if they are pouring all this capital into marketing, where's it actually going? Is it lifting all boats or just a few star products?
It is heavily concentrated. Management designated their top-tier products as power brands. And those now make up 78% of their total turnover.
That is a massive chunk of the portfolio.
It is. And those specific heavyweight brands grew at 6.0% overall, with 5.4% of that coming strictly from volume.
Wow, so the marketing is really driving physical units.
Right. When your core portfolio is driving that kind of physical demand, it tells you the marketing investment is generating sticky consumer loyalty. It is not just a flash-in-the-pan sales spike from a weekend coupon.
So they are absorbing the gross margin pressure from raw materials by running a highly efficient ship in the back office.
Exactly, which allows them to keep feeding the marketing engine.
Well, if that marketing engine is humming so beautifully for the power brands, we really need to figure out why other parts of the business are totally stalling out. Let's look under the hood at the segments.
Sure. Home care is the absolute standout here.
Yeah, posting 7.6% underlying sales growth, with 7.4% of that being volume. They actually reached their highest ever market shares in that segment during the second quarter.
And beauty and well-being posted 5.9% USG, and personal care hit 4.8%.
All heavily volume-led. But then you hit a total brick wall with foods.
Yeah, the food segment is a different story entirely.
The food segment grew a meager 1.2%. And here is the kicker. That was entirely volume. Literally 0% price growth.
Zero.
Even though it is operating at a highly profitable 23.3% underlying margin, the top-line growth is practically stagnant. Why is a consumer perfectly willing to buy more premium surface cleaner and face serum, but refusing to pay a dime more for food?
It really comes down to the mechanics of substitution in the modern grocery aisle. The switching costs for a consumer in the foods category are incredibly low right now.
Meaning they can just swap it out for something cheaper.
Exactly. If a name brand mayonnaise or bouillon cube gets too expensive, the consumer can easily reach 6 inches to the left and grab the supermarket's private label brand.
And the perceived difference in quality is often negligible for those basic pantry staples.
Right. However, in beauty, well-being, and personal care, the perceived brand equity is much higher. Consumers have intense loyalty to the specific formulation of a skin cream or a deodorant.
They are less willing to risk a breakout or a bad experience just to save $1.
Exactly. So Unilever has immense pricing power and volume resilience in health and beauty, while their foods portfolio is just trapped in a race to the bottom against generic store brands.
That divergence between the products is fascinating, but it is equally stark when you look at the geographic split. It feels like we were looking at two completely different companies forced to share a single balance sheet.
You mean the emerging markets versus developed?
Yeah, the emerging markets are dominating. They are up 7.8% in underlying sales with 5.8% volume growth. India and Indonesia are the heavy hitters driving that region.
India is a total powerhouse for them. The market there grew 8% on a consolidated basis, backed by 6% volume growth.
And beauty and well-being and home care both grew double digits there, right?
Yeah. They even noted that Horlicks, the nutritional malted drink, grew double digits, driven entirely by innovation.
Oh, wow. And what about Indonesia?
Indonesia grew 7%, which is crucial because this actually marks its 4th consecutive quarter of growth. Management credited this to a heavy focus on high-growth segments and what they term social first demand generation.
Okay, let's translate social first demand generation.
Yeah.
Mechanically, how does selling soap natively on a platform like TikTok or Instagram actually change the unit economics compared to, fighting for shelf space at a traditional big box retailer?
Well, it completely bypasses traditional retail friction. Historically, a company like Unilever had to pay massive slotting fees to supermarkets just to get their products at eye level on a physical shelf.
Right, and then run television ads hoping the consumer remembered the product 3 days later when they went shopping.
Exactly. But social first demand generation collapses the marketing funnel. The consumer sees an influencer using the product on TikTok and clicks a button to buy it instantly without ever leaving the app.
So the conversion rate is significantly higher.
Yes, impulse buying increases, and Unilever gains granular data on exactly who is buying what. Indonesia has one of the most highly engaged social media populations in the world, and Unilever completely overhauled their go-to-market execution to meet those consumers where they digitally live.
It makes a lot of sense.
We are also seeing strong performance in Latin America, which grew 7.6%, with 5.7% volume. Even Africa grew mid-single digits, led entirely by volume.
But here is where the story gets concerning, especially if you hold this stock for the supposed stability of developed markets. You look at mature economies, and the growth is just anemic.
It is definitely a contrast.
Developed markets overall grew just 1.5%. North America managed 2.7% growth. But that required them to actually drop prices by 0.5% just to secure 3.2% volume growth.
And Europe was even tougher.
Europe actively contracted. Underlying sales growth was negative 0.9%. Volume was down 0.2%, and price was down 0.6%.
Yeah, that is a tough operating environment.
Even China, which grew mid-single digits overall, was explicitly described as a soft market, where the business groups had to lean incredibly hard on premiumization just to squeeze out any growth.
Right.
Instead of calling this a canary in the coal mine, I look at Europe like an engine suffering from severe oxygen deprivation. The structural mechanics of the market inflation, exhausted consumers, intense retailer pushback on pricing are completely choking off growth. Is this just the absolute limit of consumer resilience in mature economies?
It is a severe structural headwind for sure. Europe is highly mature, heavily saturated, and currently facing persistent macroeconomic pressures that make shoppers incredibly price sensitive.
So when you see negative price growth in Europe, what does it actually mean on the ground?
It often indicates a highly promotional environment where brands are forced to offer steep discounts just to move inventory. Or it's retailer pushback where massive supermarket chains simply refuse to accept wholesale price increases.
Right.
However, the long-term investment thesis for a conglomerate of this scale relies on emerging markets offsetting that mature market stagnation.
Because of the structural demographic trends.
Exactly. The trends in India, Indonesia, and Latin America, a rapidly growing middle class, urbanization, rising disposable incomes, provide a multi-decade tailwind.
So as rural consumers in those regions transition from unbranded bulk items to branded packaged goods, that creates a structural volume shift.
You've got it. Europe serves as a highly profitable anchor that generates reliable cash flow, but Asia and the emerging markets are the undeniable growth engine.
Well, if foods is the dragging cylinder in this broader engine, how do they decouple it? Because they aren't just sitting on this 1.2% growth problem, they are actively carving it out of the company.
Yeah, this brings us directly to the transform pillar of their strategy.
Right.
The most consequential news here is the impending combination of the Unilever Foods business with McCormick, which was initially announced back in March of 2026.
And we actually just got a major actionable update on that front. On July 23rd, McCormick announced the planned operating model and the executive team for this newly combined entity.
Along with the decision to establish a secondary listing location in London.
Exactly. The strategic goal from Unilever's side is explicitly stated. They want to unlock value by shaping Unilever into a leading pure-play HPC company.
Meaning health, personal care, and home.
Right. While offloading those slower growth food assets to create a global flavor powerhouse with McCormick.
It is a fundamental shift in corporate identity, and it requires immense operational surgery.
Oh, absolutely.
To prepare for this separation and the previous separation of their ice cream business in late 2025, management launched an €800 million productivity program in 2024.
And the goal there was to simplify the business and eliminate stranded overheads, which for those tracking the mechanics of a spinoff, stranded overheads are what's left behind when a division leaves.
Right. If a company spins off a massive division like ice cream, the remaining corporate entity still has the same massive headquarters, the same bloated IT infrastructure, and the same HR department.
But suddenly less revenue to pay for it all.
Correct. Those lingering costs are the stranded overheads. Unless management actively restructures and trims the corporate fat, those stranded costs will just crush the profit margins of the remaining business.
Well, the fact that Unilever just reported this entire €800 million productivity program was completed ahead of schedule proves they have the operational discipline to execute this carve-out cleanly.
It does, and it frees up a massive amount of cash on the balance sheet.
And they are throwing that cash right back at the shareholders. They completed a €1.5 billion share buyback in the first half alone.
Yeah, and they bumped up the Q2 dividend by 3% versus last year, bringing it to €0.4664 per share.
Plus, looking ahead, they explicitly stated that the cash receipts from the McCormick separation, combined with their ongoing operational performance, are expected to support an incredible €6 billion in total share buybacks between 2026 and 2029.
It is a massive capital return program.
But let's evaluate the actual business model here. I mean, going on this strategic diet to finally figure out what it wants to be when it grows up, historically, food, even if it is slow growth, is incredibly stable.
True. People always need to eat, regardless of the macroeconomic environment.
Exactly. So by shedding these legacy recession-proof foods and ice cream businesses, aren't they removing a vital safety net? Sure, it juices the top-line growth rates in the short term, but as a pure-play health, personal care, and home company become dangerously exposed to consumer cyclicality during a downturn.
You are touching on a major debate between classic portfolio theory and modern financial market realities.
How so?
Well, historically, conglomerates offered internal diversification. If high-end skin cream sales plummeted during a recession, mayonnaise and soup sales would hold steady, smoothing out the earnings for the quarter.
Right.
But modern financial markets penalize that structure. Analysts apply what is known as a conglomerate discount.
Because institutional investors want to build their own diversified portfolios at the fund level. They don't want the company doing it for them.
Precisely. If a fund manager wants exposure to highly stable, low-growth food assets, they will simply buy a dedicated food stock. If they want high-margin, high-growth personal care, they buy a pure-play personal care stock.
So when you mix them together under one corporate umbrella.
The slow-growth food segment acts as a mathematical drag on the valuation multiples of the high-growth personal care segments.
I see.
By aggressively spinning off foods and ice cream, management is attempting to unlock the significantly higher valuation multiple that pure-play HPC companies command in the open market.
That makes total sense.
And that sheer cost discipline, the 800 million euros in savings, is the direct mechanical reason allowing them to maintain a 20.3% operating margin and fund a 16.1% marketing budget, even while facing severe currency headwinds.
Because remember, turnover was only up 0.5% in actual euros because operational growth had to fight against adverse currency exchange rates.
Right. They are deliberately trading sluggish stability for focused, highly profitable growth.
So, to summarize the roadmap for you, they clearly performed in the first half with heavy volume-led growth, and they are actively transforming for the future by shedding the food assets to become a pure play. But let's look at the immediate risks ahead in the second half of 2026.
Because there is a shift coming.
Yeah. Management guided for 4 to 5% underlying sales growth in H2. However, there is a flashing warning sign hidden in the underlying composition of that forward guidance.
There really is. The nature of that expected growth is projected to flip entirely.
Right.
As we detailed, the first half was all about volume consumers buying more physical units. But management explicitly stated that H2 growth is expected to be led by pricing.
And this is a direct response to the anticipated impact of heightened commodity costs finally filtering through the supply chain.
Exactly.
And that is the stark reversal you have to keep your eye on. We saw a 4.2% volume boom in the first half, precisely because price increases were held flat at just 0.6%. The consumer felt like they were finally getting value again.
Right. They came back to the brands.
But if the second half relies heavily on jacking up prices again just to combat commodity inflation and protect those operating margins, here's the final thought for you to mull over. Will the increasingly fragile global consumer actually tolerate another round of price hikes? Or will that hard-fought 4.2% volume growth simply evaporate as shoppers are once again forced to trade down to generic store brands? Follow the show for daily earnings coverage.